In the golden age of American radio, when the airwaves crackled with possibility and advertising dollars flowed like rivers of gold, one company dared to dream bigger than the rest. Tang Broadcasting didn't just want a piece of the radio pie, they wanted to devour the entire bakery. Founded in 1990 by Miami entrepreneur Carlos Tang, a Cuban-American immigrant who had built his fortune in real estate development, this media empire would grow from a single AM station in Fort Lauderdale to become the seventh largest radio conglomerate in the United States, commanding 117 stations across 42 states. The company's meteoric rise coincided perfectly with the deregulation fever that swept through American broadcasting in the 1990s, when the Telecommunications Act of 1996 lifted ownership caps and turned the radio industry into a wild west of mergers, acquisitions, and empire building. But like Icarus flying too close to the sun, Tang Broadcasting's ambitions would ultimately lead to one of the most spectacular collapses in media history, a cautionary tale of leveraged excess, technological disruption, and the brutal mathematics of debt that would see a billion-dollar empire vanish almost overnight. Carlos Tang's journey to radio royalty began in 1987 when he purchased WQAM 560 AM in Miami for $800,000, a failing sports talk station that most industry veterans considered a white elephant. Tang had no broadcasting experience, but he possessed something far more valuable: an immigrant's hunger and an intuitive understanding of America's changing demographics. Within 2 years, he had transformed WQAM into Miami's premier Spanish-language sports station, capitalizing on the city's growing Latino population and their passion for soccer, baseball, and boxing. The station's revenues exploded from $90,000 annually to over $2 million by 1989. Catching the attention of Wall Street financiers who were beginning to recognize radio's potential as a cash-generating machine. When Congress passed the Telecommunications Act in 1996, removing the previous limit of 20 AM and 20 FM stations per company nationwide, Tang was already positioned with a war chest of borrowed capital and a reputation as a turnaround artist who could squeeze profits from struggling stations. His strategy was deceptively simple: buy underperforming stations in secondary markets, slash costs through centralized programming and automated systems, then leverage the increased cash flow to buy even more stations. It was a formula that would make him phenomenally wealthy and ultimately destroy everything he had built. The late 1990s represented Tang Broadcasting's golden era, a period of frenzied expansion that saw the company complete 43 acquisitions between 1996 and 2000, spending over $400 million to assemble a radio empire that stretched from Portland, Maine to Bakersfield, California. Tang's genius lay not in major metropolitan markets where competition was fierce and prices were astronomical, but in America's forgotten corners, places like Biloxi, Mississippi, Cedar Rapids, Iowa, and Yakima, Washington, where local radio stations could be purchased for a fraction of their big city counterparts while still generating substantial advertising revenue. The company's crown jewel was its acquisition of the struggling Heartland Radio Group in 1998, a purchase that brought 26 stations across the Midwest under Tang's control for $78 million, financed entirely through high-yield bonds that promised investors returns of 12% annually. By 1999, Tang Broadcasting employed over 1,800 people, generated annual revenues of $340 million, and was valued by investment banks at over $1 billion, making Carlos Tang one of the wealthiest Hispanic businessmen in America. The company traded on the NASDAQ under the symbol TANG, and its stock price soared from its initial public offering price of $12 per share in 1997 to a peak of $56 in March 2000. Creating paper millionaires among early employees and turning Tang himself into a media celebrity who graced the covers of Forbes, Fortune, and Hispanic business magazines. But beneath the glittering surface of Tang Broadcasting's success story lurked a financial structure that would make a house of cards look stable by comparison. The company's aggressive expansion had been financed almost entirely through debt, high-yield junk bonds, bank loans, and complex financial instruments that required Tang to maintain specific revenue growth rates and debt-to-equity ratios, or face immediate foreclosure. By 2001, the company carried over $600 million in debt against assets that were increasingly difficult to value accurately, as the radio industry faced its first serious challenges from new technologies and changing consumer habits. The dot-com crash that began in March 2000 devastated advertising markets nationwide, as internet startups that had been spending lavishly on radio spots to build brand awareness suddenly vanished, taking their marketing budgets with them. Tang Broadcasting's revenues declined by 18% in 2001 and another 12% in 2002, forcing the company to begin selling stations to meet its debt obligations. The writing was on the wall, but Carlos Tang refused to read it, convinced that radio's dominance over American entertainment was too entrenched to be seriously threatened by nascent technologies like satellite radio, internet streaming, and something called podcasting that most industry executives dismissed as a fad for technology nerds. The beginning of the end came in 2003 when satellite radio providers XM and Sirius began their nationwide rollouts, offering consumers commercial-free music, talk shows featuring Howard Stern and Oprah Winfrey, and programming that terrestrial radio simply couldn't match. Traditional radio had always competed on the basis of being free, local, and immediate, but satellite radio challenged all three assumptions by offering superior content for a modest monthly fee while demonstrating that consumers were willing to pay for entertainment that respected their time and intelligence. Tang Broadcasting's audience numbers began declining steadily, particularly in the crucial 25 to 54 demographic that advertisers prized most highly, as listeners migrated to satellite services or discovered internet radio stations that catered to specialized musical tastes that commercial radio had long ignored. The company's attempts to compete through syndicated programming and automated playlists only accelerated the audience exodus, as Tang's stations lost the local flavor and personality that had been their primary competitive advantage. By 2004, Tang Broadcasting's stock price had fallen to $8 per share. Its debt had ballooned to $750 million, and rating agencies had downgraded the company's bonds to junk status, triggering acceleration clauses that required immediate repayment of $200 million in outstanding loans. Carlos Tang's response to his company's mounting crisis revealed both the entrepreneurial spirit that had built his empire and the stubborn pride that would ultimately destroy it. Rather than accepting a buyout offer from Clear Channel Communications that would have left him with a substantial personal fortune while preserving most of Tang Broadcasting's jobs, he chose to double down on radio's future by launching an ambitious digital strategy that included internet streaming, podcast production, and mobile applications designed to keep younger listeners engaged with traditional radio programming. The company spent $40 million it didn't have on technology upgrades, hired over 100 software engineers and digital content creators, and launched Tang Digital Media as a separate subsidiary that was supposed to revolutionize how Americans consumed audio entertainment. The venture was a spectacular failure that burned through cash at an alarming rate while generating virtually no revenue, as Tang Broadcasting discovered that competing in the digital space required entirely different skills than operating terrestrial radio stations. Meanwhile, the company's core radio business continued deteriorating as advertisers shifted their budgets to Google, Facebook, and other online platforms that offered precise targeting capabilities and measurable results that radio couldn't match. By 2006, Tang Broadcasting was hemorrhaging $30 million annually. Its debt had exceeded $900 million, and Carlos Tang was using his personal assets, including his Miami mansion and art collection, as collateral for emergency loans to keep the company operational. The digital revolution that Tang had hoped to ride instead became the tsunami that swept his empire away, as new technologies emerged faster than traditional media companies could adapt to them. Apple's launch of the iPod in 2001 and the iTunes Store in 2003 fundamentally changed how Americans discovered and consumed music, allowing listeners to create personalized soundtracks that made radio's format restrictions seem arbitrary and annoying. Pandora's internet radio service, launched in 2000 but gaining massive popularity by 2005, used sophisticated algorithms to create custom playlists that felt personal and intelligent compared to the repetitive programming that dominated commercial radio. YouTube's arrival in 2005 gave users unlimited access to virtually any song ever recorded, while early podcasts began attracting devoted audiences who preferred long-form audio content to the brief segments and constant commercial interruptions that characterized traditional radio. Tang Broadcasting's attempts to compete in this new landscape were hampered by its massive debt load, which prevented the company from making the long-term investments necessary to build digital platforms that could generate meaningful revenue. The cruel irony was that radio's fundamental strengths, intimate connection with audiences, local community knowledge, and skilled talent, remained valuable in the digital age, but Tang's financial structure made it impossible to transition successfully from the old business model to the new one. By 2007, Tang Broadcasting existed in a state of barely controlled financial chaos, selling stations monthly to meet debt payments while watching its remaining properties decline in value as the broader radio industry contracted. The company had shrunk from its peak of 117 stations to just 38, concentrated primarily in small markets where buyers were scarce and prices continued falling. Carlos Tang's net worth, which Forbes had estimated at $300 million in 2000, had evaporated as his personal guarantees on company debt left him liable for hundreds of millions in obligations that far exceeded his remaining assets. The final blow came in September 2008 when the collapse of Lehman Brothers triggered a global financial crisis that froze credit markets and made refinancing Tang Broadcasting's debt obligations impossible. The company's primary lenders, including Washington Mutual and Wachovia, were fighting for their own survival and had no appetite for extending additional credit to a struggling radio company in a declining industry. On November 15, 2008, Tang Broadcasting filed for Chapter 11 bankruptcy protection, citing debts of $1.2 billion against assets valued at just $200 million, making it one of the largest media bankruptcies in American history. The filing came exactly 18 years to the day after Carlos Tang had purchased his first radio station, a coincidence that seemed to underscore the complete cyclical nature of his rise and fall. The bankruptcy proceedings that followed revealed the full extent of Tang Broadcasting's financial dysfunction and the broader problems plaguing the radio industry as traditional media grappled with digital disruption. Court documents showed that the company had been technically insolvent since 2004, sustained only by accounting maneuvers, asset sales, and the willingness of lenders to extend payment deadlines rather than face the reality that their loans would never be fully repaid. The company's remaining 38 stations were auctioned off piecemeal over 6 months, generating just $87 million that barely covered the legal and administrative costs of the bankruptcy proceedings. Major creditors, including institutional investors who had purchased Tang Broadcasting bonds, recovered an average of 11 cents on every dollar owed, while smaller creditors, including local advertising agencies, equipment suppliers, and the company's own employees, received virtually nothing. Carlos Tang personally lost everything, including his Miami mansion, his collection of contemporary art, and his reputation as a media visionary, emerging from the bankruptcy proceedings with debts that would follow him for the rest of his life. The human cost extended far beyond Tang himself, as over 1,400 Tang Broadcasting employees lost their jobs when stations were sold or simply shut down, devastating small communities where local radio had been an important source of news, entertainment, and civic connection. The collapse of Tang Broadcasting marked the end of an era in American radio, symbolizing the broader transformation that swept through traditional media as digital technologies disrupted business models that had seemed unshakable just a decade earlier. The company's failure highlighted the dangers of excessive leverage in rapidly changing industries, as debt that had seemed manageable during radio's boom years became crushing when revenues declined and refinancing options disappeared. More broadly, Tang Broadcasting's story illustrated how quickly established industries could be upended by new technologies that offered consumers better value propositions than traditional alternatives. The radio industry as a whole never recovered from the body blow delivered by satellite radio, internet streaming, and podcasting, with total industry revenues declining from over $20 billion in 2000 to less than $14 billion by 2020, despite population growth and economic expansion during much of that period. Today, Carlos Tang works as a consultant for small Spanish-language radio stations, helping them navigate the digital transition he failed to master with his own company. His former empire exists only in the memories of employees who scattered to other industries and in the FCC records that chronicle one of the most dramatic rises and falls in American business history. The Tang Broadcasting story serves as a permanent reminder that in the unforgiving mathematics of capitalism, yesterday's visionary can become tomorrow's cautionary tale with breathtaking speed.